Welcome to this explainer. We're jumping right into a massive regulatory fix today, one that solved an absolute nightmare for startup founders. Picture this. You've spent 8 grueling years building a company from the ground up, right? Every funding round dilutes your stake a little bit more. So to stay aligned with the company's long-term success without just draining all the precious cash flow, you take stock options instead of a massive salary. Makes total sense. But then, literally right on the eve of your much-anticipated IPO, you discover a legal trap that could wipe out all of that hard-earned equity.
It is a deeply ironic situation. Could going public actually cost you your shares? Just imagine discovering that the very act of filing your IPO papers legally changes your identity. Overnight, you go from being an employee to being classified as a promoter. And because of how the old rules were written, that simple reclassification meant you might be forced to forfeit the exact equity options designed to keep you tied to the company's success in the first place. I mean, it sounds like a glitch in the matrix, right? But this was a very real, very terrifying prospect for founders. And this exact crisis threatened founders all across India's startup ecosystem. It was a massive gray area. Companies, bankers, lawyers, everyone was treating it as a huge legal risk. That is, until the regulator stepped in. They actually had to amend the SEBI share-based employee benefits and sweat equity regulations of 2021. That's the consolidated rulebook governing every single equity award issued by a listed company. So, to really get the fix, let's quickly look at the 6 ways companies share equity. Whenever a listed Indian company wants to reward its team, it uses one of these schemes. You've got your standard ESOPs, the right to buy shares later at today's fixed price. You have employee stock purchase schemes for immediate buying, and stock appreciation rights tied to the rising share price. Then there are general employee benefits and retirement benefit schemes to fund welfare. And finally, sweat equity, which are shares issued not for cash, but for crucial know-how or intellectual property. Now here is where we hit the crux of the problem. Looking at employee status versus promoter status, the regulations said an employee can hold these ESOPs, but explicitly blocked promoters. And, on paper, that makes perfect sense. You want to prevent conflicts of interest, since promoters already control the company. But this created a huge unintended regulatory gap. When founders transition from employee to promoter upon filing their draft red herring prospectus, or DRHP, the rules just went totally silent. Suddenly, their eligibility to hold the ESOPs they earned years ago was completely unclear. And this ambiguity wasn't just some theoretical legal quirk. Industry bodies were sounding the alarm. Back in June 2025, the Startup Policy Forum literally called it a structural bias against listing. Think about it. If you force founders to surrender their options just because they file for an IPO, you're stripping away their financial skin in the game. It completely defeated the purpose of incentivizing them in the first place, and it heavily discouraged fast-growing companies from ever entering the public markets. To really understand why the regulator had to move, just look at the sheer scale of the stakes here. $100 billion. At the time of this debate, there were over 30 Indian startups worth a combined $100 billion, reportedly eyeing IPOs in the near future. This wasn't just a small administrative typo. This was severe regulatory friction, threatening to choke off a vital pipeline of public market offerings. A gate simply had to open. So how did SEBI respond? Well, they were incredibly methodical. They didn't rush a patch job. They started with a public consultation paper in March 2025, which laid out the problem and got unanimous support from 15 commenting entities. Then, moving along the timeline, the SEBI board formally approved the fix on June 18th. Finally, on September 8th, 2025, Regulation 9A was officially notified. It was a disciplined, highly transparent process. So let's talk about Regulation 9A, because this is the exact legal mechanism that saved founders' equity. It essentially allows founders turned promoters to keep their ESOPs. But, and this is a really big but, there is a strict 1-year cooling-off period. The options or sweat equity had to be granted at least 1 full year before the DRHP filing date. SEBI anchored this to the IPO filing to ensure absolute clarity, basically proving the options were a legitimate part of compensation, not just some last-minute trick to grab shares before listing. Let's break down those boundaries a bit more, because SEBI didn't just create a free-for-all here. Pre-existing grants made outside that 1-year window, those are protected. But notice the restrictions. It absolutely does not allow founders to receive new, fresh ESOPs after they officially become promoters. Plus, SEBI rejected any special lock-in exemptions. Once those old options convert into shares, the founder is bound by the exact same post-IPO lock-in periods as everyone else. It's a really well-balanced rule to protect fair compensation while preventing misuse. The market reaction was immediate. It was widely celebrated in the press as a big relief for startups and their founders, and you can easily see why. It stopped that terrifying scenario of forced pre-IPO sell-offs dead in its tracks. And broadly speaking, it sent such a positive signal to the market. It made reverse-flipping companies, startups thinking about relocating their headquarters back to India to list, feel so much more secure about making that move.
Now, alongside ESOPs, there was a second, slightly quieter update regarding sweat equity. When you issue shares for intellectual property or know-how instead of cash, it obviously requires an independent valuation. Previously, this was typically done by a merchant banker. But effective January 2nd, 2026, it must be done by an independent registered valuer. Merchant bankers do get a 9-month grace period to wrap up ongoing work, but this change really tightens the professional accountability of putting a price tag on a founder's intellectual contribution. Stepping back, we can really see the cascading benefits across 4 key stakeholders. For founders, it's about certainty, knowing your hard-earned equity won't just evaporate on a technicality. For investors, it guarantees alignment because a founder with real skin in the game makes better long-term decisions. For companies, legal teams can safely plan compensation without navigating a gray zone. And for the broader markets, it unblocks that massive pipeline of high-growth IPOs we talked about earlier. So Regulation 9A fixed the glitch, but it replaced ambiguity with rigid discipline. You've got to navigate that strict 1-year cooling-off period, and you are totally bound by post-IPO lock-ins. Thanks for joining me on this explainer today. As you pressure test your own readiness for the public markets, you really have to look hard at your cap tables, your grant dates, and your IPO timeline, and ask yourself, under these strict new rules, is your pre-IPO equity truly secure?